Thanks everyone for joining us. I'd love to start out, a lot of people think of ESG as ruling out companies based on tobacco, weapons, things that you don't want to be invested in. But I'm curious, how can ESG potentially rule things in? Are there companies, do you have examples of companies that you found, that ESG helped you find? I'd love to start with you, Dana.
Well, first, I think I need to explain CalPERS is the largest asset owner in the United States, so my perspective is that of an asset owner. We're a $360 billion fund, and we pay benefits to 1.9 million active and retirees. We pay $23 billion a year in benefits. So when I look at ESG from an asset owner perspective, I look at it as a methodology for underwriting risk. I believe that there are off-balance sheet items that impact performance and also identify opportunities. So to me, it's a risk lens. And when I see companies that CalPERS is invested in that maybe don't have good governance structures, which we all agree is a driver of return, we'll use engagement to drive to increase alpha on those companies, as well as our proxy votes.
I think that a lot of people do still continue to associate, first of all, ESG with negative screening, but that actually really isn't what's been driving a lot of the growth in this area. We are the largest provider of environmental, social, and governance information to the global investment community, so we see this wide diversity of uses and approaches to ESG, and I think the most fundamental distinction to make is actually between whether you're taking an investment-driven rationale to incorporating ESG factors, or whether you're taking an individual preference-driven rationale to incorporating ESG. And if your goal is to improve long-term returns and reduce risk, you're really taking an investment-focused rationale, where ESG factors is really just using additional information alongside traditional financial analysis, and that just gives you more information to work with. There is still approaches that are looking at individual preferences, and the more modern data, if you will, permutations of that would be around impact investing, where investors do want to have a greater exposure to a positive social impact. But really the core is actually still to use ESG factors to improve your risk-adjusted returns.
Do you have any examples of how it has done so?
Well, there's a lot of evidence actually in that if you are only selecting the financially material issues by industry, that over the last 10 years, there's a lot of academic industry evidence now showing that the higher rated ESG companies, for example, have been more profitable. I think that they have paid more dividends, they have experienced less earnings variability and a lot less tail risk. And that's just true over 1,600 stocks over 10 years. So that's really fairly robust data set.
Yeah. Lorraine, I know you have also been tracking some of this. I'd be curious to hear, how has ESG kind of helped you identify new opportunities?
Sure. So we're different in the sense that we are a mission-driven organization. So Just Capital is primarily a research firm interested in driving capital towards just companies. So we are different in that we don't actually look at materiality. We're polling the American public on what's important to them in terms of just corporate behavior. So that takes us beyond what's material in certain industries. Our focus is U.S. large cap, so we're looking at the Russell 1000 primarily. And we find that companies that score well based on our rankings, which are heavy on the social issues, for example, equal pay, gender pay, parity, providing benefits for workers, they actually also display lower volatility and lower beta, and so our studies are in line with what we've seen in the academic community, but just a different approach.
Do you have any examples of companies that you found that do that?
Sure. I mean, well, in 2018, Microsoft was our top-ranked company. So we work with Forbes to publish our top 100 and point out the characteristics that got them there.
Yeah. Matt, I'd love for you to weigh in a little, because there's so many different criteria that you could be looking at in ESG, and people view ESG differently.
Right.
What have you found to be the most important criteria to look at that could have the most impact on finance and management or ultimately results?
Well, unfortunately, the answer is it depends. We spent the last 2 years. I wish there was one little one silver bullet, or one thing I could point to. But we spent the last 2 years on a lengthy project with PRI, and we went around to 23 different financial centers around the world in 17 different markets, and we asked our members, CFA shareholders, and financial professionals in general, how they understand ESG, how they use it, those kind of questions about what is ESG, what methods do they use, what are best practices. And we found a cacophony of answers. There isn't really one best way to do ESG integration. There's no agreement on what the definition of ESG integration is, unfortunately. Wherever we went, whether it was very sophisticated investors in the Netherlands or folks who were just coming to ESG for the first time, like in Brazil, for example, they focus a lot on the G, but not the E and the S so much. Wherever we went, about a quarter to a third of the folks in the room equated ESG integration purely with negative screening. They thought they were synonyms. That's not the way we look at it in the CFA curriculum or the way we look at it in our advocacy work. The way we look at ESG integration is what are the factors that are material in that market, in that industry, in that sector, and focusing on those. A good example is the SASB standards, the Sustainable Accounting Standards Board out of San Francisco has spent the last couple of years working with analysts in industry to pinpoint what are the half a dozen to a dozen key drivers in oil and gas, in water, in software. And that's a good baseline to start with. They just finalized their standards last year, and we find that's a good baseline to start with, and try to focus on whether you're a firm that has 2 or 3 people who can look at ESG, or a firm that has a team of dozens of folks who look at ESG. The reports we came out with try to give a way for people to integrate ESG into what they're doing, whether they have a small shop like that or a big one. But unfortunately, the shorter answer to your question is it depends. You have to read the 600 pages of reports we did to get that answer.
Are there some that rise to the top, certain examples, if not a clear?
I could give examples. For instance, CalPERS in our real estate portfolio, we went to increase energy efficiency. Mm-hmm. We reduced our kilowatt usage by 19 million kilowatts. We also increased net operating revenue by 35 million, and these drivers are increasing the bottom line over time. In the 11,000 public companies that we are invested in, and mostly it's through the index, we're using our proxy as well as engagement to get diverse directors on board. 155 companies have added a diverse director. 126 reporting they're going to enhance board diversity over the short term.
Yeah. Gareth, I know you look at a lot of data in your process. Tell us a little bit about that, and what have you identified as certain things that have really worked for you?
Sure. So I come from the asset management side. So our job is to make this work, right? To actually take the data that's out there, look through the headline figures into the detail where there's a lot of nuance and where the information really lies, and then build that together with fundamental data and other sources of data to build a full picture of the company. So our company, G Squared Capital, since we were founded in 2011, we've been using deep ESG databases. And the one thing that we have learned is that really it's a real gold mine, but it's not at the level of, not at the superficial level of just the top rating. It's really when you get into the detail. Example would be, there's a lot more information in the trend of, let's call it an ESG rating over time, than there is in the actual baseline rating. Another example, if you look deeply into specific industries, and there's 69 industries that stocks fall into, there are different ESG factors which are material in each one of those 69 industries. And so if you can start to condition and segment in that manner, and you can imagine a lot of other ways to do it, you can start to tap into where the real information edge is. And why that's interesting and why we're passionate about it is ESG itself has to add value to be sustainable, right? Well, what's the point of having, a pathway, an investment segmentation, which detracts value over time? We can't have that as a sustainable part of the picture. So we're absolutely passionate about proving that there is deep information value there, and we just treat it like an alternative data source. Actually, it's one of the strongest that we have. So we're pleased that everyone on the panel has been driving the conversation over all of these years, because where we sit right now is thousands and thousands of structured and unstructured data points about a company, and if you use a machine approach to pass through that, you find some real nuggets of information.
Can you give an example of what one of those nuggets might be?
Yeah, so nugget's an interesting word, because it's about, picking up the rare, looking under the rock and finding the rare positive story that the market hasn't fully priced. But it's also about avoiding the blow-ups, which is a large part of what you want to do as an investment manager, right? If you want to improve your returns or reduce your risk, the main pathway for you to do that is to avoid the left tail, avoid the blow-up companies. It's very difficult to do. So an example that system avoided very easily are examples like Valiant Pharmaceuticals, General Electric, several years ago, where there's just a lot of information beneath the surface that gives you an indication that these companies are not on the right track. And so you can just step away and avoid those situations.
Now, Valiant, in that example, with their pharmaceuticals, it was something, their distribution model, which ended up, being their downfall. But was that what you identified, or did you identify something else that caused you to skip over them, even if it wasn't the main issue that it was what was so terrible for the company?
Yeah, when we have a look at the Valiant story, our model produces actually the number of ESG factors which negatively scored Valiant, to put it in simple terms. So yes, dozens of them. Examples would be they were going into, even in the positive years in terms of stock price, they were aggressively reporting their earnings. They were moving things off the balance sheet. There was a whole host of governance issues around compensation. So there was a lot of red flags, but it's not, you need to be able to look at it unemotionally and not be involved in the management and the story and all the rest of it. If you just step back and look at the data, there's a lot of red flags there.
That's fascinating.
Yeah. Can I just,
please.
I think Valiant is a good story, and I think that there are many that come across, over the last, couple of years, and even more recently, Vale, the Brazilian mine that collapsed, PG&E and the wildfires, Nissan and every single one of these, if you had been tracking it systematically, you would see warning signs beforehand. And I think that the ESG ratings approach is really systematizing a way to kind of sift for those outliers in terms of risks. So I think I agree with Matt that it depends, but the depending part of it doesn't have to be ad hoc. It can actually be very, very systematic. And so the way we would select issues to put a weight in for ESG ratings would be that all companies and industries do have corporate governance as an issue, because we do think that's really fundamental. But beyond that, they would be very different, right? So it's something like an Equifax, half of its ratings comes from privacy and data security and consumer protection issues, and then it's corporate governance and human capital management. That's it. It does not have to be the whole host of other environmental, social governance issues out there.
Yeah, speaking of privacy, I wanted to talk a little bit about the tech and internet sector, because this is a sector that's really historically ranked very highly on ESG measures or ESG scoring, because they have a low environmental impact and they treat their workers really well, giving away free lunches and all of that. But lately we've had, with Facebook and privacy issues and issues about what kind of content should be shared and what is able to be shared. I'd be curious to hear from you, how are you viewing these tech and internet companies? I mean, would the process have potentially ruled out Facebook when they had their big fall earlier this year?
We would look at their governance and their board diversity. So I think that was an underlier in Uber. It's been an underlier within the tech industry.
Yeah.
And also in their performance going forward and reputational risk.
Yeah. Lorraine, do you want to add to this?
Yeah, so I echo what Dana said. On top of that, I would say we seek transparency. So we have a portal where the companies can see the data that we've pulled on them. We don't ask them to provide any data. And so, when they want to know, how we got to our conclusions, it's there. And also on our site, for Facebook, you can see workers is an issue that we rank very highly. That comes out of our survey, so it's a 25% weight in our rankings. And so, like you were saying, they score really well on worker benefits and other services for their workers, but privacy and local communities was actually an issue that we flagged.
Yeah.
And gender equality.
And just with a lot of the tech companies, corporate governance is a big issue, especially the dual class share structures.
Right.
Facebook, it's something everybody knows, so it's a good test case of, the whole board and the whole company depends on what Mark Zuckerberg does and wants to do. And that's putting all your eggs in one basket. If the structure of the shares is it's Mark Zuckerberg's company and the board is there, but they can't really do much if he goes off on a tangent and wants to do something that isn't in shareholders' interest. The structure of the shares means there's not much shareholders can do about that. So that's something we knew from the IPO, and a lot of other tech companies have followed that model. So it'll be interesting to see in the future years if we have similar problems where something goes wrong, but there's nothing shareholders can really do to change things.
I think there's a little bit of misconception, though, that somehow from an ESG perspective, say oil and gas and mining companies are all poorly rated, and then healthcare and IT are highly rated. That's actually not the approach. I mean, if you want to not be in certain business activities or sectors, you don't really need ESG analysis for that. So, the approach really is that we assume that you want to be broadly diversified. And so what you're trying to do is use ESG methodology or analysis to choose the companies that are better at managing the material risk for that industry, and the ones that, and avoid the ones that are doing the worst. And so from if you're looking at a Facebook, then you'll be comparing it against its peers in terms of what are the material issues. And the highest weight in its rating has to do with privacy and data security, and it has not done very well, since its IPO. It has actually improved since its IPO, but it's not kept up with the rest of the industry in terms of the way they're managing privacy and data security issues. So it remained, quite lowly rated.
Yeah. How heavily weighted is privacy, cybersecurity in the model, or is it equal weight, or is that fairly heavily weighted?
That's fairly heavily weighted. It's more than 25% of its weighting.
Oh wow. Okay. Yeah. Gareth, do you want to have something to add?
So I can be explicit because we have to decide whether to own or not own stocks, and we have a long-short portfolio. We're short Facebook, and the system sees a lot of issues with what you're talking about. And here's where you get a bit nuanced, right? So ESG investing has become such a popular wave that the corporations that we're all investing in are well aware of that, and they can start, as we were speaking about, they can start to game the system. Right. So what can happen very easily in terms of, this is a greenwashing category, is a corporation can say, well, look, I know the ratings agencies are looking at, the ESG ratings agencies are looking at these issues, just as they did with credit ratings, and they can tick those boxes, and they can look like the big things are working well, but beneath the surface there's one or two really, really fundamental things that they're pushing way too hard. So it's kind of, if you think of it, it's non-linear. You can have 9 things out of 10 that you do very, very well, but you miss that one that is the iceberg. And that's a problem that Facebook's having, right? You can do all of this gender diversity, you can have wonderful employee benefits, you can have low turnover, you can have all of this stuff, but if you're getting one of the big things wrong, the whole company is a risk. So that's one of the things that we look, and again, you can have a good rating for Facebook, but from our perspective, there are serious problems beneath the surface.
Yeah. Are you shorting any other companies because of ESG measures?
So about 60% of the companies we avoid or that we short are dominated by ESG factors, predominantly governance issues around aggressive accounting and around related party transactions, all sorts of boring stuff that in the notes of financial statements, which I don't even know why humans still want to read those, right? I mean, the machine's bored reading this stuff, let alone a human being. So that's really what the system focuses on. And so 60% of the companies that we avoid or short have strong materiality from ESG factors.
Yeah. Speaking of avoiding companies, I mean, often there's a choice I think you guys have between divesting from companies or divesting from certain sectors or engaging with them and trying to change their practices. Dana, I know you've been very active in engagement, and CalPERS rarely divest, but you did actually divest from certain gun makers in the last year or two. I'd be curious to hear, what your thought process was like and your approach to engagement in general.
Okay, well, our thought process, which is driven by our values and our mission, is we believe in engagement before divestment, because if you no longer have a seat at the table, you cannot effectuate positive change or increase alpha. So as a board member, one of the things I'm typically, and this might be more unique to me, against divestment, because we pay, like, for instance, tobacco. That was very controversial. I was outvoted. We're still divested from tobacco, but it cost us $8 billion. Had we still had tobacco in our portfolio, we'd probably be $8 billion ahead. And because every time you divest, you pay fees. And then you pay fees to redeploy that capital into other assets. So when you're as large as that, as CalPERS, that's significant. So I believe in divestment when the legislature of California mandates it. Regarding guns, after the Parkland and Vegas shootings, we engaged 5 of the retailers who we have significant positions in and asked them about their gun policies going forward. 3 of those retailers raised the minimum age to sell a gun. 1 stopped selling guns completely. So our policy is engagement first before divestment.
And one thing on engagement, it's interesting to see, it's grown so much over the past 5 or 10 years. The ESG teams or sustainability teams or the engagement teams of the large institutional investors in the U.S. have grown just tremendously over the past 5 to 10 years because a lot of them are indexed and they can't sell or don't want to sell. It's a last resort. And so what they do is they see, look, I can make an investment, a small investment in this team, and we can engage in company A, B, and C who are red flags in our portfolio. And if we can improve them through engagement, we don't have to incur all these fees for selling. We improve them and we lift the value of them. It's a small investment to make on the front end for the staff and the training. And I've seen a lot of that. We've seen a lot of that over the past 5 to 10 years. Just huge growth in engagement teams. And on the other side, issuers making a similar investment on people who do engage with the companies. It's not just an IR function. It's someone, more and more, it's someone who's tasked with managing those relationships.
Yeah, Lorraine.
Point to add to that, so engagement's a big part of our model as well, and when you talked about it's not just IR, to add to that, the corporate portal that I mentioned, it's the portal where companies can log in and see their data. Well, when we first started, as a startup a couple of years ago, barely anyone used it, and last year, 350 companies engaged with us through the portal. But what's fascinating is it wasn't just IR or human capital management teams. It's now general counsels, and some companies have up to 6 different senior employees logging in and commenting on the data. So it's fascinating how that's changed.
Yeah. Linda, are you active in engagement at all? Or?
So we serve, all the institutional investors many of whom are using ESG information as part of their stewardship and engagement programs. And some of the trends that we've observed is that, a lot of them have traditionally had strong, robust stewardship and engagement programs around corporate governance issues. And it's only been in the last couple of years where environmental and social issues have really come up the agenda. I think that often, they are slightly defensive in nature and event-driven. So because we serve so many investors, when there is an event, whether it's a shooting or a mining collapse, our phones kind of ring off the hook, right? And that's because a lot of investors have to very quickly know where those companies are in terms of their risk management, risk oversight of that particular issue. But in addition, whether there are other companies in their portfolio that may be facing very similar issues. So the other thing is that, obviously they're using it to engage with the specific companies, but I think that there's also just rising expectations in terms of transparency to their own stakeholders and their own clients, because people want to know, if you are a good steward of their capital, what it is that you're actually doing to address a specific issue and a specific risk in their portfolio.
That's great. Gareth, do you have something to add?
Yeah, obviously, it's an interesting perspective, right, to come from our world, which is quantitative-based, machine-based decision-making, picking companies that system thinks will do well. So if you think about two converging trends, I'm just interested to see where they end up. One of the obvious trends in investment management is that discretionary managers are giving way to the machines over time. I don't just mean, trade execution. I literally mean decision-making around picking companies, so bottom-up research, obviously. So, that direction is pretty well set, and it's very clear there will be increasing automation on the investment management side. And at the same time, so what that means, obviously, there's more quantitative firms like us that are wanting to start to integrate ESG, and then they face the problem of how do we improve our ability to engage with companies? So to start to systematize that process will be the next phase, right? To start to use machine learning to figure out what is it about our portfolio companies that we could feed back to the management of those companies, which is proven to be material, not subjective, not some sort of loose standard, but literally, here's where you fit in your industry. Here are the very precise measures which affect your financial return, the points of the spear, and here they are for you to deal with, and here's the evidence. That's the kind of direction that we want to go in. It's not competitive with the others, but it's complementary, and I think in 5 years' time, a lot of the people-heavy side of these businesses will start to be more and more automated, as it should be.
Mm-hmm. So do you have you identified certain points that you could already send to them?
Yeah, absolutely. That's what we do. Yeah.
Yeah, like what? Like what?
So, I mean, we talked about there's many different industries, right?
Mm-hmm.
And so what you can do is it's a technique called unsupervised clustering, where you can look at, in an industry group, where your company fits and how you could, and if it's a negative cluster, how you could move to a more positive cluster by pulling the lever on 2 or 3 critical ESG factors. So it's more precise, right? Rather than just saying you need to improve your ESG, it's saying these are the most material in your industry. This is where you're lagging, and if you move the needle, you will enter this cluster where you have better cost of capital, better returns, etc. So it's very precise.
Yeah. One issue I find really interesting from an ESG perspective is cannabis, because here you have now, it's legal recreationally in California and several other states, medically legal everywhere, so it's in some ways it's a medical product, but at the same time, obviously marijuana has been viewed as a vice, as a sin stock potentially. How do you navigate, or how are you seeing investors navigate this? I mean, Dana, you're based in California, would CalPERS consider cannabis?
Well, it was interesting. I was saying to my fellow board members, when I was against divesting tobacco, I said, well, how would you feel if it was cannabis? Because I think the tobacco companies are strategically poised they have mass distribution, they have packaging, if they got the federal regulations to take advantage of it. And I'm told in California, you're going to be able to go cannabis tasting, like there's areas in Napa where you'll have different vintages. So I think we would look at it now as more medicinally rather than recreationally, so in terms of seizures, the medicinal impact.
Mm-hmm. So it is something you're considering investing in?
Well, I don't know we'd making a direct investment, but to the extent that we're in certain pharmaceutical companies that are doing things with cannabis.
Yeah, there's become more publicly traded companies now that do have cannabis investments in various
Correct.
areas. Yeah, so it's interesting. Matt, sorry, go ahead.
I think on cannabis, the regulatory side of things needs to shake out first
Right.
before people will feel comfortable jumping in from an investor's perspective. Not all, but some. I mean, some more people will feel comfortable. The federal things have to be sorted out before before there's a gold rush in cannabis, I think.
Yeah, but you said there are some of of investors that you've spoken with who actually are looking for it in an ESG portfolio and some that are looking to avoid it, or is it mostly on the avoiding side right now?
I think it's not a topic that came up much in our discussions. It did a little bit here. It did a little bit in Canada. Like people from here go to Canada to invest because there's some cannabis companies there that have already started. But for the most part, they're just kind of waiting on the sidelines to see what happens.
Yeah. A lot of our clients are very interested in cannabis, and I do think it's a great example of an issue where we have clients who are using it as a negative screen, just like they are divested from certain other types of businesses, and then they are using the same. Some of them, others, are using the same screens as a positive screen because they think of it as a thematic investment. But then, if you're looking at it, from an investment center perspective of what are the financial risks and opportunities here, a lot of it is around the regulations and the dynamics of the regulatory landscape in different jurisdictions for the companies that are actually involved in cannabis. So there's a very active monitoring among many of our clients in looking at the pharmaceutical sector or beverages and tobacco to see kind of where this actually kind of shakes out.
That's really interesting. We have a couple minutes left. I wanted to. A lot of you talked about the fact that you're not looking to sacrifice performance. You're still looking, to outperform the market just with an ESG perspective. And Lorraine, I know you had some interesting examples of how you've actually been able to show, companies that have increased their returns, increased their return on capital or equity, based on how they treat their employees. I'd be curious to hear a little bit more about that.
Sure. So we published a paper in April. It was really interesting. Human capital management is a theme that we're focused on, which is in line with BlackRock. Larry Fink's spoken about it. And so disclosure is really what we're focused on. So we looked at 9 metrics, and companies that disclosed on 8 of the 9 metrics actually had an added ROE benefit, anywhere from 1.2 to 3%. And so for us, that helps make the case really on the investment side for companies that this is an area that they should be paying attention to. So, daycare services was really up at the top, and I mentioned gender pay equity earlier, and that had a 3% added ROE advantage for the companies that we looked at, and this was out of the Russell 1000, so it was really impactful to see that come to light.
Yeah. Anybody else want to add in terms of what they found to certain things that have been able to increase their performance?
I think one thing that hasn't been mentioned yet that's useful, data point is the supply chains is incredibly rich source of information, right?
Yeah.
And now you can map that in an extremely sophisticated way and look at the feedback loops and look at the contingencies and interdependencies. So there's a lot of dark matter in the supply chains of corporations which otherwise look very, very good. And that's an old story. We all remember the Nikes of the world back in the 80s. But that sort of stuff is happening now. You can map globally a corporation's supply chains and their suppliers and get a good sense of where things are happening. So one example would be, a tangible example perhaps, is that people always, when you're assessing a company, a human analyst will look at whether or not that company is diversifying across its supply chains. But what if you're diversifying across supply chains, all of which those companies have extremely low ratings on various measures? You're compounding your problem. So supply chain's key.
That's a great point.
Great. Well, that's our time, but thank you all for the great discussion.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.